Thanks a lot. First of all, happy greetings, everyone. This is Ron William, technical strategist, independent technical strategist, actually tuning in this webinar with FX Street from London. I'm now based in London at the moment for this week. And the webinar is on Fibonacci, the secret behind Fibonacci analysis. For any of you that have any questions that you want to shoot at me probably afterwards, please feel free to either contact me on my new website at www.ronwilliam.com, which has just been launched recently, or just email me on roniwilliam@gmail.com. I can also be reached on Twitter, rwilliam77, if you want to follow some of my real-time updates. And of course, feel free to connect with me on LinkedIn. And for blogs, I update a few blogs, key market blogs, on forexstreet.net, which is the blog set up by FX Street. So I'm going to get started immediately. Thank you very much for holding on just now with some of the IT issues. I always like to begin with what it is that I do, my specialization, and that has always been for many years now, market timing. I've been officially in the market for around 13 or so years, and market timing has been the most focused area of mine, and that just basically means being able to find important turning points in the market, partly or primarily by looking at cycle analysis, so being able to forecast a roadmap into the market, but also looking at correlations between different markets. And then, of course, on a more intraday short-term perspective, I will use for some of my trade setups Japanese candlesticks, patterns, which is something I focused on for some time, and advanced indicators such as the mark indicators and my own proprietary strategy, which I've used over the years. Now, there's three parts to this webinar or this presentation. We're probably going to spend most of our time on part one. Hopefully get some time just to maybe touch on part two. But keep in mind that part one is history and theory, so focusing on Fibonacci, the man himself, and this whole idea behind the Fibonacci sequence and the golden ratio, which is found within the Fibonacci sequence. Part two is really hands-on application, and I'll probably save some of that for the follow-up webinar, part two, where we talk about the ratios, but then actual examples in the market that can hopefully help you here and now. Part three is how to integrate all of this that we talk about within your own trading techniques. I spend some time talking about a system approach where you look at a three-step system approach, which includes cycle analysis. And then I talk about advanced Fibonacci tools. This is something that isn't really spoken about as much, but I talk about how you can use Fibonacci not just for retracements and extensions, traditional stuff, but actually to identify geometric relationships in the market. So I'm going to start now. I'm going to make sure that if you do have any questions, to interplay from the and then onto the presentation. So I'm just switching now. Does anyone have any? If anyone have any questions, I'll flip to the chat in a few minutes. And just in question to you, Harley, hopefully I'll include a one or two historical secrets about Fibonacci at the moment, but probably the big secret will come in part two when FX Street decide to organize the follow-up session. Okay. So Fibonacci is a man, a very famous man, Italian great mathematician. His full name is Leonardo Pisano Bigolo. Excuse my poor Italian accent, but basically he lived between several hundred years ago, between 1170 and 1250, also known as Leonardo Bonacci, and actually his name his actual name was Leonardo Bonacci, and I think later on down the line, when he became famous after he passed away, for making the relationship behind phi and his Fibonacci numbers. I think later on he then got renamed Leonardo Fibonacci. But he became famous for a book that he wrote during that time called Liberace, and it's famous for advancing European Roman the numerical system and basically revolutionizing the financial industry as we know it. And the way that he did that is just by integrating the knowledge that he had learned through the Hindu-Arabic number methodology. So basically what that means, I mean, one of the things that means is he introduced fractions into Roman numerical system, and before they didn't exist, and so they're working on whole numbers, and the whole accounting and financial market process was quite conservative and not as sophisticated until he actually introduced this in a book that he published called Liberace. Within that book, of course, it featured a unique number sequence which later became named after him, as we know it, the Fibonacci numbers. Now, the Fibonacci numbers were pretty much discovered by Leonardo Fibonacci by asking the question as to relating to rabbits, what I call the rabbit quest. As all great scientists or mathematicians, they always ask a question that seems unanswerable at the time. And his question was a question based on nature and based on the reproduction of natural creatures such as rabbits. And his question was, how many rabbits will there be in 1 year? So if a pair of rabbits were to start reproducing now, how would their family tree of expand? What would be the growth cycle in mathematical equation? What would that be? So it looks something like this if you were to actually try and plot it out. And what we call the Fibonacci growth cycle, which can be found throughout the world, throughout nature. And it's basically very simple. You start off with a pair. So, for example, 1 plus 1 equals 2. Then you have a pair. And from 2, you then basically add the sum of the previous two numbers to each other. And then that builds the Fibonacci growth sequence. So 1 plus 2 equals 3. 2 plus 3 equals 5. 3 plus 5 equals 8, and 5 plus 8 equals 13, and then from 13 to 21 to 34 to 55. But visually, this is how it looks if you were just to kind of plot it out as some kind of a map. And this was more specific to what Leonardo Fibonacci was trying to experiment with when trying to work out the reproduction cycle of rabbits. But of course, this cycle can be found through many other things in nature. Now, the key thing behind the Fibonacci sequence is, of course, the mathematical pattern sequence itself, and there are many other patterns that exist in mathematics. But the key thing was the golden ratio. I mean, that is everything, basically, and that is the key reason why the Fibonacci sequence was so important, and is so important. The golden ratio is described as a ratio of 1.618, or the inverse of that, which is 0.618. And this is a golden ratio, a magic ratio that is basically found in everything around us, in the universe, in Earth's nature, in the human being, and whatnot. And I'll talk about that in a little while. And the way that you can calculate the golden ratio is by calculating, dividing consecutive numbers in the Fibonacci sequence by each other. So, for example, remember I mentioned 13 and 8 were Fibonacci numbers from the sequence. So 13 divided by 8 equals 1.618, or 8 divided by 13 equals 0.618, so the inverse there. And phi is basically part of sacred geometry. It governs nature. So it's a geometric law of nature that has existed since the beginning of time. Now, ancient civilizations studied many key subjects, otherwise known as key art, especially mathematics, music, astrology, and sacred geometry. Most notably, the ancient Greek mathematicians and philosophers led by names that you might know, Pythagoras and Plato, furthered these legacy teachings, which they had learned from various other ancient civilizations, including, of course, the ancient Egyptians at that time. And you can see there the ancient pyramids of Giza, one of the 7 wonders of the world, which is an example of how ancient civilizations actually built great structures based on the golden ratio within their architectural design. Now, remember I mentioned that the golden ratio also is important within nature. Well, this is just a quick kind of slide I drew up here just to explain what that means. A few people call it the golden ratio as God's fingerprint. So for some of you who maybe have a spiritual belief in God or in great powers that may have created this world, it's very much the DNA, the fingerprint of this world, of the universe that we live in. And you can find it in plants. You can see there the bonsai tree. The symmetry that exists within that bonsai tree is based on a golden ratio. I put a picture of the Vitruvian Man, so the famous picture drawn by Leonardo da Vinci, just basically showing the ratios within the human body as being part of the golden ratio. And then specifically, I've overlaid the golden ratio on a model of human DNA. So this is what human DNA looks like. And if you were to subdivide that DNA strand, both widthwise and horizontally, vertically and horizontally, you'll see the ratios there, 618 and 382, being found within the subdivisions of human DNA from the horizontal and the vertical measures. Now, what's interesting is the golden ratio not only exists in things around us, but also in psychology. And there's a famous experiment that a gentleman called George Kelly, back in the 1950s, he ran a psychological test on several people, basically asking them questions, positive or negative questions, and he plotted that out on a probability distribution, which you can see here on the screen. And interestingly, the actual skew or the results of this survey that he ran had a golden ratio breakdown. So that's an example of how people express their views in a psychological test, suggesting that there might be some kind of a link to the golden ratio in how we think. Now, this is not only found within psychology, but it's also found in markets. I can send you details of the person that then ran this test on financial markets, but there was another test, it's exactly the same chart, but the results were very similar, theoretically speaking, where they measured the number of bull markets versus the number of bear markets. And what they discovered is, again, there was this golden ratio embedded within bullish and bearish cycles in the market. I can send you details about that test if you just send me an email. I can follow up with you on that. But the point is that human psychology seems to have this golden ratio, and of course the markets being driven by human psychology, mass psychology, the golden ratio was also representative of the market itself. Now, a big believer of this statement is Robert Fraktur, the infamous practitioner behind Elliott wave analysis. And his famous quote, which I like to use in presentations like this, is that stock prices are humanity's valuation of its own evolution. I'll say that one more time. Stock prices are humanity's valuation of its own evolution. Now, I would like to probably just ask, just in the chat here, just to keep it interactive, I'm going to flip to the chat screen. Can anyone tell me what they think that means? Stock prices are humanity's valuation of its own evolution. So I've already told you the markets are a measure of mass psychology. But can anyone tell me how psychology and this golden ratio may or may not be important to the stock markets? Just get some feedback from some of you here in the chat. We've got an extensive kind of group of people here from all over the world, and I'd like to just open that question. What is everyone's perspective on how the markets work, mass psychology, and this idea behind golden ratio being part of that market DNA? Any feedback? I know Gonzalo's here, so I can ask him to pitch in as well. So Harley's saying people's emotions while trading. Absolutely. At the end of the day, the market is made up of human emotions, and we are all, millions of us around the world, trading the market. And so if potentially our human nature is reflective of the golden ratio in terms of the patterned way that we think, that could be a reflection in the market. Carlos is saying that it may be too simplistic of an answer, potentially. Rocky's saying like stock prices swing, I guess. Yep, that's a fair point. Simon's saying sentiment. Mike is saying it's reflections of symmetry in the way we are made, in the way that we think. Thank you very much, Mike. That's actually probably the best statement, which I think kind of explains it. And that's very true. I think the more you research this, the more you understand that a lot of things are interconnected. And while they logically or scientifically might not be so conclusive, for some reason there's this unanswered reason why things exist as they do. And I like to kind of keep those questions unanswered most of the time, because there are many things in this world that we have yet to understand. Harley's making an interesting point, which I like to kind of put under the devil's advocate kind of category, in that, and it's a popular one, self-fulfilling prophecies. Harley, could I ask you what you mean by that before I jump in? If you could explain what you mean by self-fulfilling prophecies in terms of, are you saying that the Fibonacci numbers and the ratios, Fibonacci ratios, work because many people look at them, or something else? GY, I always wonder if the market is following the Fib ratios or people know the ratio and follow the ratio pattern. I think that probably actually helps answer the question that Harley just made. Patterns, repetition, and psychology is what Harley is saying. And I'll go back to what GY is saying. I always wonder if the market is following the Fib ratios or if people know the ratios and follow the ratio pattern. To some extent, there is some self-fulfilling prophecy in that people do know the numbers, the Fibonacci numbers and the Fibonacci ratios, and so they do obviously trade off it, or they pick it as an entry and exit level. But a lot of the time, it is the market actually experiencing its own natural growth cycle, growth and decay cycle, which is linked to the golden ratio. Borg is asking a good question, why were rabbits used? Good question. I don't know the answer behind that, but I think, as with all scientists, they pick some form of test hypothesis to use, and rabbits on this occasion were used. I'm not sure if there's a link to how the production cycle of rabbits that could be potential, but I'm not sure the exact reason. But it just so happens that the growth production cycle of rabbits were intricately linked to the Fibonacci sequence that he later on published. Rocky's saying market price is a lot like human life, ups and downs, tends to get more under or overvalued at times. Yeah, absolutely agree. And I'm gonna pause there for a moment and go back to the presentation and just say thank you everyone for your collective thoughts. It really is what makes the webinars that much more enriching. And there are many people here from all over the world. I usually ask that question, where are you based around the world? And I'll do that in future webinars. But I'm always pleased by the response that I get. Harley, you can see there, is from the US. Usually we get many people from the US, from Norway, there, and a few others. I'll let some of you kind of introduce yourselves and just say which part of the world that you're from. Carlos is from sunny Miami. Keller is from Poland. India, I think I am. Brazil. Rainy UK. Yeah, I've been in the UK for a few weeks and it's been rainy here for some time. Simon from Malaysia. Hi, Simon. QI from rainy London. Ali from Pakistan. Got a real kind of mix here. Cat Pips from Germany. Sanjay from India. Boyki from Africa. Boyki's a resident supporter here of all of us here at FX Street. Emmanuel from London and KTT from Japan. Must be very late there at the moment. Emmanuel from London, and I'll continue. Okay, I'm going to speed along now. So we have a mix of people around the world, but the key thing is this idea behind Fibonacci and cycle. Okay, that's part one. I'll kind of launch into part two, but probably save some of the market examples for our follow-up webinar. We have 25 minutes to go, or maybe 20 minutes to go. Okay, so part one was the history and the theory. I spoke about Fibonacci, the great Italian mathematician, the Fibonacci sequence, where you just add one number, the previous numbers to each other, and you then get this sequence of numbers. And then the key point that the golden ratio, phi, is found within this Fibonacci ratio, but also through sacred geometry, the way the universe is designed. Now, part two, we're going to focus on application. I'm going to talk about the key Fibonacci ratios, 38.2%, 50%, 61.8%, how they're derived, but also why they're important. Quick point about price retracements and extensions, and then we'll probably end off on market examples. Now, in the follow-up webinar, which the FX Street team will announce at the end, we'll probably talk more about market examples, and then part three, integration. So how do you actually use Fibonacci to trade in the market? And I'll kind of also then talk about advanced Fibonacci tools. So not just for retracements and extensions, but many other things that you can use Fibonacci. Fibonacci or the golden ratio can be found throughout financial markets, movements, price, and time. And this is something I focused on for many years. Okay, so the ratios which are really important are basically 38.2%, 50%, and 61.8%. And the ways that you basically get these ratios are as follows. If you use the Fibonacci sequence, remember that sequence is 1, 2, 3, 5, 8, 13. So 1 plus 1 equals 2, 1 plus 2 equals 3, and so on. If you pick some of the numbers within that sequence, for example, 55 divided by 144, you then get 0.382. If you divide 1 divided by 2, you get 50%. And if you get 21 divided by 34, you get 0.618. Now, the explanations behind that have been faded out on this slide, unfortunately. So you'll just have to kind of take what I've said as the conclusion. But there are various ways that you can get these ratios. The bottom line is if you have a trading application, you will just have these ratios already programmed for you. So this is just interesting information. But a lot of these ratios are already pre-calculated on your trading software, whether it's MetaTrader or whether it's what I use, Bloomberg. Now, there are other ratios that you can use, and these are just three that I'm talking about. But I mainly start off with I prefer to start off with these three ratios. The problem is that there are so many ratios, and this is something that I spoke about at the fantastic ITC conference in Barcelona with FX Street this year that passed, in that, you know, we have so many different levels that we can look at in the market. And Fibonacci analysis is one way to derive levels in the market to buy and sell or to exit our trade. And the key thing is you really need to keep it simple, and you need to use things that work for you. And I think most of the expert speakers there had also said something similar. So I like to use these three ratios, and I call them the primary ratios, 38.2%, 50%, and 61.8%. Now, the way I like to describe these ratios is that I kind of play a trick here, and I say, keep in mind, let me go back to the previous slide, that 38.2% is very similar to 33%, and that is 1/3. 50% is actually half, and 61.8% is close to 66%, which is 2/3. So I often make this comparison between the Fibonacci ratios, 38.2%, 50%, 61.8%, these Fibonacci ratios and proportions, psychological proportions. So 38.2% is very similar to the proportion of 1/3, 50% is the proportion half, and 61.8% is close to the proportion of 2/3. And I say that for a few reasons. One, because when people find themselves not so sure about the Fibonacci sequence and why it works and why it's relevant, I say, well, okay, forget about the kind of mysticism behind these golden ratios and just think about the psychological implication. And the psychological implication is it's just very simply that these proportions, 1/3, half, and 2/3, if we were to convert them to 33%, 50%, and 66%, are just psychological proportions that the market is going to pay attention to because of the market structure, because of the psychology in the market, and so on. But also to say that second point why I make this comparison is because I use both ratios, both the Fibonacci ratios that I've shown you on the screen, but also the actual proportions that can be relevant in market moves. And any questions on what I just said there? Because sometimes I get questions here. So I'm going to answer some of the questions. So we have about 30 minutes or 36 minutes left. When is part 2 scheduled? I'll let the FX Street guys let you know, but basically sometime next week, potentially, if we can fit it in then. Borky's saying, why 50 as not a Fibonacci number? And Mike is saying the 50 level does not have anything to do with Fibonacci, but traders use it because of the tendency of prices to reverse after retracing half of their previous move. Thank you very much, Mike. That's actually a perfect explanation. 50%, I think most people agree that 50% isn't a Fibonacci ratio. You can derive it from some of the Fibonacci numbers, but that's kind of stretching it out a little bit. I would say, yeah, mainly as Mike said, people realize the 50% level is quite important, but one of the market practitioners, famous market practitioners that really believed in the 50% or the halfway mark rule is W.D. Gann. And I follow a lot of Gann's work over the years. Gann is one of the prominent technical strategists from the 1930s, had a fantastic track record, and he really believed in this 50% rule that markets tend to retrace half of the prior moves or extend half of the move. And this is very much kind of a key pivot level in the market, to the 50% level, for many reasons. Does that help answer your question, Boyke? So you can derive the 50% level from the Fibonacci sequence, but it's kind of stretching it a little bit. And I would look up Gann, the work of W.D. Gann, and what he believed about the 50% rule of how markets tend to retrace half of their prior move or extend half into the future in terms of price and time projections. So the 50% rule is actually something that I really look at quite a bit, both in price and time projections, and that's something that takes a lot of time to actually implement. So 50% is very important. And actually, that's one point I'll make very quickly here, in the next slide, actually, because it's easier. One of the ways that I explain how these ratios can be used in the market is through a metaphor. And that metaphor here is a building structure. And so what better structure to use than the tallest building in the world, which is the Dubai, the tower in the Emirates in Dubai, one of the tallest skyscrapers in the world. And I just basically say that, my example here is that the financial market is very similar to a building, a tall building, in that you're basically trying to understand key structural points to that building. That's basically the analogy that I'm trying to illustrate here. And so any building has a ground floor. You can see that's the ground floor line there. just at the bottom of the chart, ground floor, otherwise known in market terms as 0% level, or the base level, the historic low. And every building, tall building, or market structure has a ceiling, which would be maybe the entire move that had happened historically, the 100% level. So every building has a ground, has a ceiling. Then within that, you have key internal structural levels, or subdivisions. And of course, the most important key subdivision is the halfway subdivision, the 50% halfway point. And same thing, all architects and all engineers know that the middle structure of any building is very important. But then within that, the further subdivisions, of course, as I said, 1/3, 33%, 2/3, 66%. But of course, the Fibonacci equivalent is 38.2% or 61.8%. Is everyone okay with this kind of comparison that I'm making between, first of all, buildings, tall buildings, having a ground floor, ceiling, and then a midway point, halfway mark, and then within that you have these subdivisions of 1/3 and 2/3, which is kind of similar to the Fibonacci sequence of 38.2%, 50%, and 61.8%. Everyone okay with that? If we can just get a few yeses or nos. This is the time to kind of say if you understand, and if you don't, please feel free to let me know. Okay, so most of you are saying yes. Boyke's asking a good question. What about basements? I'll explain a little bit about what I mean now, and then I'll move on to the next slide. Okay, but I'm glad at least it just makes sense to you for now. Okay, Boyke's joking. Thank God for that. Okay, but either way, I'll try and add a little bit more to what I was just saying. Okay, now the key thing to keep in mind here is that the most important points in the market are the extremes, the historic extremes, the highs, the historic highs, and the historic lows. And it's very important in any market that you look at, whether it's Eurodollar, gold, Aussie yen, any market, commodities, fixed income, equities, that you know the historical picture of that market. And usually the best way to do that is to look at as much history as possible. But when you look at that history, understand the characteristics of that market, the market structure, but also look at the extremes. So the extreme climaxes within climactic moves within that market. The highs, extreme highs, and extreme lows. And this is what I mean by the ground floor and the ceiling. How tall is that building? And you can only really know that when you know the full range of that building. What was the extreme high in Eurodollar? What was the extreme low in gold? It's really important to know that, especially when the market volatility has increased as it has done recently, and it's important for that reason and many other reasons. And so within that, then you can get an idea of the internal structure of the building. And in market terminology, if you read your kind of classic technical analysis books written by, for example, Martin Pring and John Murphy, some of the technical analysis gurus of the last decades, they talk about markets tending to retrace, if we switch back to market terminology, 1/3 of their prior move, half of their prior move, or 2/3 of their prior move. And usually the rule of thumb is that markets that retrace 1/3 of their prior move, that is a healthy correction. So if you've got a piece of paper and pen, just quickly write that down just so you can just make a mental note of what I'm saying here. Any market that rises from 0 to 100% tends to retrace about 33% or 38.2%, and on a regular basis, and that tends to be a healthy correction. So that is something that we see. It's a common move. We see it on a regular basis. Markets tend to retrace their prior moves by about 1/3, 32% or 38.2%. That happens regularly. That is a common move. So when you see that type of move, you can expect the market to then rest for a little while and then resume its uptrend or its downtrend thereafter. Now, the halfway markets, of course, if they don't stop at that 33% level and then continue lower, if they're retracing their uptrend, then they retrace half of their prior moves, these are really key psychological levels, areas at which the market has basically lost half of what it made, or the inverse if you're looking at a different trend. And at this point, it's a make or break level. So the 33% or 38.2% is a healthy correction. The 50% halfway mark is a make or break level. It's a key structural point in the chart, which can either be bullish or bearish. It's not clear at this point. Now, when a market retraces 2/3 of its prior move, 66% or 61.8%, whichever ratio you want to use, keep in mind that the textbooks, the technical analysis textbooks, theoretically say that if the market retraces more than 66% or more than 61.8%, then that is a signal of a trend reversal. And then potentially a signal that that trend, up or down, is going to retrace the full move. So we head back to the ground floor, the basement level, or the 0% level, where we start our analysis. And that is the key message here that you need to understand behind this analogy that I'm illustrating here, behind a tall building being very similar to a market. The structure of a tall building is very similar to how we try and identify a structure of a market. You look at the historical patterns within that market, the historic high, the ceiling, and the historic low, the ground floor, and then you subdivide for internal levels, 1/3, half, and 2/3. But keep in mind that 1/3 is a healthy correction, half is a make or break level, and 2/3 is a signal of a trend reversal if we get a close beneath that, and a signal of a full retracement to come back to where we started. Now, I'm going to go to the chat. Is that okay to everyone here? Because this is probably the big lesson here that I want you to take away from this part 1 webinar on Fibonacci analysis. So if we can just quickly read the questions. So Rocky's saying, does this sort of calculations come from structural engineering, support, resistance? It's the analogy that I'm using. Structural engineering, of course, has a lot more sophisticated rules that they and guidelines that they go by, but certainly these are key structural levels within, I guess, engineering and architecture. There's a lot more, but these are just kind of maybe my simplistic explanations of how the two examples compare. GY is asking the question, how about 50% and 61.8%? Can you explain? Thanks, Rocky, for your vote of confidence. I appreciate it. It's always good to also get the constructive and positive feedback to know that we all understand each other. GY, can you please explain what you mean by how about 50 being less than 61.8%? What do you mean by that? So less than 61%, but over 50%. Okay, fine. I mean, it's open to interpretation, and these are just, think of them as just signals of what happens in the market. So you can see it as positive or negative. Probably the most negative signal out of what I've just shown you is if a market retraces more than 66% of its prior trend, then that is seen as a bear signal, basically, in an uptrend or a bull signal in a downtrend. I'll leave it open to interpretation, because how people trade these levels is, of course, down to your trading style and down to how you filter out market movements on these levels. But just keep in mind the textbook signal of a bear or bull signal for the trend is when a market retraces more than 66% of the prior trend. So that is seen by most as a strong bear or bull signal, depending on the trend. Okay. So I'm going to quickly give some historical examples of retracements and then extensions. Can I just quickly check with the F3 guys, how much time do I have left? Can you just give me a quick time check? I'm guessing probably have about, well, a few minutes left. Okay, so we have about 15 minutes or so. Okay, so I'll just end off on some of the market examples and maybe try and get some questions from each of you. Okay, so retracements. I'm going to just stick with what you all know. Everyone in the market uses Fibonacci, and they mainly use it for price retracements and price extensions. There's a lot more that you can use Fibonacci for, and stay tuned for the part 2 presentation on Fibonacci where I talk about the secret behind geometry within the market based on Fibonacci ratios. But for now, retracements and extensions, and then we sign off with a few questions. So retracements, we just basically look at swing points in the market between, let's say, point A and B, and I've just highlighted point A in green, point B in red. And what we do is we basically subdivide these two swing points from in a market, and we subdivide it by 38.2%, 50%, or 61.8%. So you can see here, you just see a market move. It can be euro-dollar, it can be the dollar-yen, and we just basically subdivide it, and we want to find out point C. The market has risen from A to B, and we want to know if the market is about to fall, how far will that market fall by? How much will that market fall by, both in price and in time? But in time terms, we measure a 38.2% measure of the swing points between A and B. And like I said, that is a healthy correction. If the market stops there, it's maybe a good place to buy some more in line with that uptrend that we've seen previously. In the other example, we've got point A and B. The market's broken below the 38.2% level, and we now look for another key structural level. And like I said, the next structural level is the 50% level, and that is a make or break level. And then in the third example, we have swing points A and B. The market's broken below the other retracement levels at 38.2 and 50%. Now we're measuring the 61.8% level, or the 66% level if you want to measure 2/3 of the prior trend. And then that gives us an indication of the context of the market fall from that uptrend. Now keep in mind that, of course, you can use this on uptrends and downtrends, or you can just use this on different swing points in the market across different time frames. And the key point that I made, that 61.8% or 66% retracement of the prior trend tends to be a clear bull or bear signal that there's a full reversal of that trend taking place. So here's a long-term example on euro-dollar, and this is actually relevant now. This chart isn't up to date, but what I'm saying to you is very relevant to the here and now. This is the euro-dollar trend from the beginning of the bull cycle in the year 2000, up to the peak in 2008 when we had the financial crisis. And if you just measure that swing point from point A 0.8T231, which is extreme low in euro-dollar back in 2000, to the extreme high on euro-dollar 1.6038, when the European Central Bank got really nervous about euro being way overvalued, and what a big change we're in now with all the negative contagion in the European region. When we measure these swing points, point A and B, and we subdivide it to point C, the 50% level, what we get is 120.125, which is very close to, well, recent price activity. So the euro-dollar hitting 121.25 basically is telling us that euro-dollar has lost half of what it has made since the bull trend of 2000. Euro-dollar touching 121.25 means that it's hit at a very important level, very important structural level, that's the 50% level, and that basically means that euro-dollar has lost half of what it made since the bull cycle began in 2000. Is that clear to everyone? Just quickly go to the chart. Okay, so I think we'll wrap up on that. But is everyone okay on what I just said there? Just checking there on euro-dollar, because that's probably a key takeaway trade point that I want to make. Euro-dollar is at a very historic level at the moment. I've gone live on this in many presentations, but also on the record with media interviews that I've given recently. Rocky's saying, over the period of time, these levels are followed and learnt by everyone. We may be stopped out as all major players know the stop loss place. Yeah, to some extent, a lot of people are going to be aware of this level, especially when when you have market experts maybe going on television talking about it, as I did recently, and also people being able to kind of do the measures themselves and reach the same point. one point I'll make here, because whenever people kind of make this, the conclusion about the self-fulfilling prophecy, this is a question that came up in the panel discussion at the ITC FX Street conference in Barcelona. As people use technical analysis more and more, do we run the risk of increasing the self-fulfilling prophecy? Do people just really start to kind of use the same analysis? Does that kind of decrease the value of the analysis? And my answer is no. Partly because a lot of this, for two key reasons, and it's probably a good point to end on this example of euro-dollar and the key level at 121.25. Everyone is going to interpret this level in a different way. Some people are going to look at this as a potential positive signal, potential negative signal. I haven't said whether it's positive or negative, but people are going to interpret it in a different way. So the interpretation on levels, patterns, indicator signals, if I was to expand this debate across the board, is going to be different for different people. We are all different, and human nature suggests that humans are going to interpret things in a much different way. And this is the whole point behind human psychology, thinking in different ways. Especially if you're an aggressive or conservative trader, you're going to treat these levels differently. So my first point to how people are going to use this key level on euro-dollar at 121.25, this 50% level of the bull trend from 2000, is that everyone is going to interpret it differently. So interpretation is different. The second point is everyone is going to trade it differently, according to whether you're an intraday trader, a short-term trader, and so on. So you might not necessarily, as Rocky just said, you might not necessarily get your stops pushed out of the market at this level if you wanted to use it at that level as a stop out level. What I would say, or any other level like an entry level or so on, I wouldn't use the level exactly, to be fair. So I'd say I'd maybe use maybe pick a few pips away from that level, a few percentage points away from that, around that level. The other thing is, keep in mind that you need to get time confirmation. So whenever I identify these key levels in the market, whether it's a Fibonacci level or whether it's just a classic resistance support level, it's always important to have a time filter. So for example, do you want to wait for an intraday chart? You've seen the signal break out on a 50-minute chart. Do you want to make sure that it sustains on an hourly basis? Do you want to make sure that it closes on a daily basis, on a weekly basis? So always look for time filters. So if you see a signal on a 50-minute chart, wait for the hourly chart. If you see a signal on an hourly chart, wait for the daily close. If you see a signal, a breakout from a key level on a daily chart on a closing basis, maybe wait for a weekly close if that's the time frame that you're happy to stay with. And Rocky's very kindly encouraging me to follow in the next webinar. I'm going to end off there because I think it's a good point to wrap up and probably take some of your questions. So Mike is saying, can you share your thoughts on Fibonacci time, Fibonacci fan indicators? Yeah. So in the second webinar, that's actually what I've set up in part 3, where I actually talk about Fibonacci tools, not just for retracements and extensions, but also for Fibonacci for measuring geometric moves in the market, such as Fibonacci fans, Fibonacci cycle. So this is something that I'll talk about then. GY is asking, what do you think euro-dollar will do next? I think 120, 125, that level that I'm highlighting to you, is going to be a very important level in the market on euro-dollar. One that we will likely break. I mean, I do see us then venturing down to the 120 level. But keep in mind that from a macro perspective, the reason why euro-dollar is so bearish right now is, of course, because of the negative news in Europe. And I think that, and of course, part of this unwind in risk appetite, euro-dollar is basically seen as a risk appetite proxy, along with the S&P, the Western equity markets, and now markets like gold and silver. Keep in mind that we are currently seeing a seasonal unwind in risk appetite, and I think I have long said that that is likely to continue for the second quarter of this year and the third quarter of this year. So I see further euro-dollar weakness and risk appetite unwinding into the month of October. And then I do see a big change of that cycle where we get a rally recovery in risk appetite from October onwards into year end when we get the US elections. And now going back to Eurodollar, so I see a move below 121.25 and potentially into 120. But at some point in time into the month of October, I see risk reversing, rotating from Europe back to the US. So one of the reasons why Eurodollar is so negative is because of the bearishness or the contagion risk within Europe, which is so much more than the US. I think that changes. So the US dollar is currently performing very well if you look at the dollar index, just because of this unwind in risk appetite, because of the increase in volatility, and people kind of increasing their safe haven flows back into the US dollar, which is kind of seen as a stable reserve currency still until this day. But I think that will change from October onwards. The US dollar is likely to decrease in value, and we're likely to see maybe Eurodollar rise from these extreme lows that we've seen. Is that clear to everyone? So there's a few reasons why I still see further downside in Eurodollar into the month of October, but I see that from a cycle perspective, after the month of October, things turning dollar negative, Eurodollar positive, and risk appetite starts to recover again into the end of the year. Now, Black Cat's asking, the dollar index is at a 38.2% retracement on the daily chart. Yeah, the dollar index is approaching key levels. I still think the dollar index is going to actually punch much higher. So please be aware that even if the US dollar index, the DXY, looks like it's hitting key levels, it's only going to be a temporary kind of unwind or consolidation around those levels. I think that US dollar will continue to push higher. So if your signals are reading overbought on US dollar, try and kind of take that with a little bit of salt, because the strong market will be overbought. The strong uptrends, the strong downtrends will be oversold. So overbought signals on US dollar does not necessarily mean that US dollar is going to reverse. It just means that the market is likely to rest within this strong uptrend, which is going to continue, in my opinion, until October. And keep in mind, from a macro perspective, it's part of this unwind, this massive unwind of risk appetite trades, as a lot of these trades became overcrowded from last year into spring of this year. And so some of it's profit taking, but a lot of it is also seasonal unwind as the volatility increases into the month of October. Now, Black Cat's asking is, do you think that Eurodollar will hit the 50% retracement level, or will it break beneath it? I think I kind of answered that question. Eurodollar is likely to break beneath 121.25, maybe not immediately, but eventually, i.e. a week later or a few weeks later, and head into 120. And as I like to say, time will tell. No one knows. A lot of this is based on certainties, not a lot of this is based on probabilities, not certainties. But my probability of the analysis that I do suggests that we do get a break below that level. The other thing I'll say is I'll probably just kind of just say this tentatively, and I'll try and include it in the next session, is that levels are just, levels are levels. That they're not more, they're not less. So try not to think of a level. A level can do a few things. It can either stop a market move, or it can accelerate that market move. And sometimes that level produces a fake out, a whipsaw. So where the market just breaks above the level temporarily and then reverses back above or below that level. So just keep in mind that although I've highlighted this key level in Eurodollar, which is a key retracement level of the entire uptrend from 2000, keep in mind that these levels don't tell you whether the market is going to stop or not. It just tells you that the market, it may stop the market move, it may accelerate the market move, or it may produce a fake out whipsaw signal. So bear in mind that this is another reason why, even though a lot of people are aware of this level, it does not mean that everyone's going to trade it the same way, because the market might react differently against that level, as is always the case. How many times have you had a stop level which was triggered and your trade was still right, but your stop was elected and you had to get kicked out of the trade. Okay, so I think that wraps up. We've run out of time, and we've covered some good ground here. The next webinar, I'm just reading the screen here, is on the 14th of August at 3 p.m. Now it's scheduled, that is the true nature of trends. I'll confirm with the FX Street guys whether I continue to do that webinar, or whether and when I do this Fibonacci webinar part 2. But thank you, everyone. It's a pleasure and honor, as always, to share this knowledge with you. Appreciate your patience at the beginning of the webinar. Sorry about the IT issues. Thank you, FX Street, once again, for being a great support team. Maud, congratulations on moving to Barcelona. It's a beautiful city. I hope to visit again. And I hope you enjoy your time now with FX Street on the ground. And all of you guys, Mike, Carlos, Gonzalez is there somewhere, Simon, thank you so much for your support, and stay tuned for the next webinar coming up after mine, but also the part 2 Fibonacci that is scheduled soon. Thank you very much. And if you have any questions, keep in mind my email address, roniwilliam@gmail.com, and my recently launched website, ronwilliam.com. Thank you very much. Bye-bye.